Hi, welcome to our video series here today. This is Jordan Bradford and I'm here with Eric Burkholder, and we're going to do a little market recap here. And we're not quite halfway through the year, but wanted to provide some updates because there are some things going on in the markets right now and just the U.S. economy in general that we thought would be great information to get out to everybody. So we'll go ahead and kick it off, but I think some important information we're going to talk about is inflation. There's some good GDP numbers, corporate earnings, and performance across the board and within the different major market indexes that we follow.
Right. Yeah, and I think as we get into some of the updates, something I'm always just, I guess, not surprised anymore at this point is like there's always something, right? And we'll talk about a few of those things, but I think it's important for everyone out there to keep in mind that there's always uncertainty. There are hundreds of thousands of variables that can impact investments, and so while we do monitor all these different metrics and what's going on, and it's important to keep abreast of what's happening in the market, uncertainty is part of our economy, it's part of investing, and so it's the norm is not normal,
right?
If that makes sense.
Right, and it always feels like there's news that you can attach to any way you think the market is going to go. There's always good news out there and there's always bad news, and you can latch on to either side if you've got a preconceived notion with how you think the market's going to respond. But I think some of the numbers today might seem a bit surprising, and some of the numbers may seem right in line with what you'd expect. But I think the big thing to remember is there's thousands of variables that are going into the market every single minute of every single day. So trying to use any of this information that we're going to provide today or any information that you read to make a market timing decision is statistically not a very good likelihood of succeeding there.
Right.
So we don't want you to use this for market timing. This is really for information, help you maybe feel a little bit more comfortable with what's going on in the economy and in the markets today.
Yeah. So Jordan, you want to kick us off with some updated numbers for the year?
Yeah. So I'll start with inflation because that's a big one. As of the end of April, we're now at 4.9% inflation in the U.S. So that's continued to trend down. It has been trending down a little slower the last few months than maybe it was towards the end of last year. But if you remember back to the summer of 2022, inflation was up over 9%.
Yeah,
so
8.9.
8.9, yeah. So right around 9%, and that's a big drop from that.
Yeah.
Now it's still higher than what we want, but the trend is that we're seeing some easing up of inflation in the U.S.
Right, and it's good to point out that the increase is decreasing. So that's I think does get confused in the narrative. It's still the inflation prices are going up higher than we want, but they're going up less quickly. So I think there's been some confusion because inflation, the headline number is down, but that still means prices are going up.
Right.
So we're getting close, but we got some ways to go.
Yeah, it reminds me of back in grade school, or I guess high school, really, probably when I learned this in physics about the difference between speed and acceleration.
Right.
Just because you're moving doesn't mean you're accelerating. You could be decelerating, but still moving and going forward. So that's kind of how that works with inflation too. Is we still have inflation, but it's to some degree decelerating, and that's the good news.
Right. Which is, we got a long ways to go, but it is going pretty well compared to where we were, like you said, just 6 months ago. And then in light of the Fed interest rates and trying to tap down inflation without sending us into recession, which is the major concern. And I think you have some numbers on GDP.
Yeah. So, the first quarter estimates are in for GDP in the U.S. and it was positive 1.1%. So that's really nothing to write home about. I think it actually was a little lower than what the overall expectations were. But if you compare that to the first quarter of 2022, First quarter of 2022, GDP was negative 1.6, followed by a Q2 GDP of negative 0.6. So last year we had a technical recession. By the traditional standard definition of recessions, we had one in the first 6 months of 2022. And coming into this year, that was like the big cloud that's looming over the economy and over the markets this year was, are we going to enter a recession, a real one that we all experience, right? Not just a technical recession for 2 quarters, but something that's going to maybe drag out for a longer period of time in the economy. And I would say that, having a positive number in the first quarter, that's a win.
Absolutely. Yeah, I mean, it seems like, I'm hopeful that I'm not giving the credit to the Fed mostly, but they will take the full credit for this, that they can get us to avoid a recession and get inflation down. I think there's a lot of other factors outside the Fed, but that certainly is the best case scenario. It looks like we have a chance of doing that.
Yeah.
Which, several months ago, I think everyone was pretty much decided we're either going to have crazy inflation or we're going to have to go into recession. No other options. And I think, again, it just shows it's very hard to predict what happens in the economy and markets. And so hopefully, fingers crossed, we are moving in a direction that was a small chance, but seems more and more likely as we go along.
And I think that when you look at GDP and you look at the potential of recessions, there's another factor in there that's corporate earnings, because recessions are really driven by a lack of liquidity then in the markets, because people are no longer spending money, and so you'll see earnings will drop, which means we're spending less money. And that's where you're going to see that GDP number come down and your more traditional recessions. But we're filming this video on May 16th here, and as of last Friday, roughly 92% of U.S. corporations have reported their earnings, with a 78% earnings beat. Now, on the surface, that just sounds really good, and it is actually very good. But the 10-year historical average has been 73% as an earnings beat. So, in any given quarter, we would expect that roughly just under 3/4 of companies reporting earnings will beat their analyst expectations. And in the first quarter, that was actually up a little bit so far. So I think that's a good sign. I think that shows that maybe the underlying economy is a little healthier, especially as inflation has dropped than maybe what we thought 5, 6, 7 months ago.
Right.
So those are good signs.
Yeah, and probably somewhat connected to that number would be unemployment, which is still at record. Unemployment is at record lows. So
yeah,
we just haven't seen that uptick in people filing claims. Again, there's a lot of factors that lead into that, but we will take low unemployment over the alternative.
Right.
And so, the economy just kind of keeps chugging along and seemingly just kind of surprises us on the upside a little bit with each new data that's coming out. So, the markets in the economy are not the same. We say it all the time, but I think you're seeing that kind of play out in the market and performance as far as, most markets are positive year to date, but then we've seen quite dramatic fluctuation, especially, March and going into April, because of some of the uncertainty that still remains.
Right.
So maybe give us some updates on market returns.
Yeah, so as of last Friday, the Dow Jones year to date up only 1.2%. Now the Dow Jones is only 30 individual stocks. It's not necessarily the broadest barometer of the economy, but it's a popular one and a lot of people follow it. So that one's up 1.2%. The S&P 500, which is, I would say, arguably the most commonly used in terms of people comparing their investment returns to something, is going to be the S&P 500. That's up 8.1%. Which, that's a return number that I think most people would be happy with in a given year. It's a little lower than long-term historical market averages, but I think most people would be happy if they could earn 8% every year, or something close to that. So I think, that's a good sign as well. And then the NASDAQ, which had a horrible 2022, is up 17.7% right now year to date. You would think that that would mean like, okay, growth is back, it's on top again. It's still well below its highs because if you recall watching our videos last year, especially at the end of the year, where we talked about what that means when anything performs negatively, especially large negative numbers, like the NASDAQ being down roughly over 30%, you needed about a 50% return to get back to even. So if you were 100% a NASDAQ investor in 2022, you're still looking at needing roughly, another 33% positive performance to get back to where you were on January 1st of 2022. So while that's great that the NASDAQ has seen some rebounding this year, it's got a long way to go before it gets back to its highs. So don't think that that ride or that roller coaster on the NASDAQ is over yet, because it's far from it.
Yeah, it's an unfortunate product of the human brain, which I'm speaking for myself and everyone else, is that we cannot do, compounding math in our head.
Mm-hmm.
We tend to divide things up in fairly simple, either quarterly or annual performance, and that can really lead to some bad decisions, because if you just looked at year to date right now, you'd say, hey, I'll take almost 18% all day.
Mm-hmm.
That must be the best place to invest. Well, if you look at a 2-year time frame, you're still way off because it was so down last year. And then even if you go out 3, 4, 5 years, can still be very misleading if you don't have the entire time series and the entire, say 10 years of performance to really understand how things behave. Because we're drawn instinctively to recent performance, and as we know, that is not indicative of future results, and it can be a dangerous road to go down.
Yeah, that's why we really preach, not to chase returns. It's not about trying to find whatever was the hottest mutual fund stock ETF in 2022. It's about finding the best portfolio of diversified investments to fit your goals. And if you're just chasing performance and returns, you're going to be constantly lagging, because, if I look at those 3 indexes, I think the Dow Jones, to me, looks the most attractive simply because it's only up 1.2%. That could change, and that could be flat tomorrow. Mm-hmm. So that, if you're just looking from a performance perspective, you should actually avert your eyes' attention off of the high performer and go towards a low performer. But that's also not going to be your best strategy either, because again, we don't want to make our investment decisions based solely on performance. But it just gives you a good sense of where the market's at right now. It's a little bit all over the place. Mostly positive, but all over the place, from stuff that's done pretty well this year to stuff that's essentially just kind of treading water in 2023.
Yeah, and there's been a lot of uncertainty this year so far, as we just mentioned, and a lot still on the table. We have a debt ceiling negotiation currently ongoing, and so there's always nervousness around that. I'm optimistic that a solution will be found. So since 1960, we've had 78 times where we've either temporarily or permanently increased the debt ceiling, and this seems new. Obviously, defaulting would not be new, but this debate, these high stakes negotiations tend to happen. Both sides are trying to leverage it the best they can. Mm-hmm. They tend to end up doing the right thing. I would say it's the right thing. We were just talking before the video, regardless of your opinion on spending, both Republicans and Democrats have approved the current budget and spending.
Yeah.
They are now not going to raise debt to pay for those obligations. So regardless, maybe we should spend less. That's fine. We can debate it, but they've already agreed to pay X amount of dollars. You got to pay for it. And then later, if you want to cut spending or something, that you should do that. But right now, they've already agreed to it. They should raise the debt ceiling. That's my opinion. I think that's pretty reasonable. Mm-hmm. But again, the economy, politics, government, all very uncertain. This all goes to show that a portfolio and your investment strategy should be based around what you're trying to accomplish, what your risk profile is, what your risk tolerance is, and because we don't know. Right now, it looks like the economy is doing much better than we thought it was going to be. Inflation's coming down, employment looks good, earnings looks good, but then we have a debt ceiling, and it may next year it's not going to be the debt ceiling, but it'll be something else.
Right.
And
Well,
so-
statistically, it'll probably be the debt ceiling too, because that happens more
Sure.
than once a year. But it will be another set of factors that come up as
Right.
well.
Right.
And I think that's the exact message we like to convey is you can't control all of what's going on in the news. We can't control what Fox, CNN, any of the news companies, what they're saying and what they're talking about with the markets. They're trying to get viewership, and all the news companies are really doing that today. So you can't let that dissuade you from sticking with your investment plan, especially one that you've done in conjunction with your ultimate long-term financial goals. Because if you've aligned those correctly, all of this stuff is just noise in any given year, because we're going to have all of this happening all the time. It's just a matter of what day are you reading the news.
Right. Yeah.
Mm-hmm.
Well, that we covered a lot, but as usual, if anybody out there has additional questions, we're happy to answer them and tell you what we know. And we'll continue to get more economic data, more earnings, and as usual, we'll continue to move forward and build good portfolios for people. So that's all our time for today, and we will see you all in the next video.